When there's a dramatic repricing of a market, such as the one recently seen in crude oil, there's a period of instability in the market that can be very costly if you fail to take it into account. The old trading adage that the market takes the stairs up and the elevator down really applies here. Dramatic repricings tend to happen whereby markets sell off hard and fast, so there's an element of bargain hunting that goes on. People are looking to take advantage of oversold prices, but there's always the selling momentum that motivates more selling as well. Big firms in trouble can and do have to scramble for the exits, and this can make the moves lower harder while the hunger for bargain basement prices intensifies as a market threatens to retrace. Opportunist day traders hang on every bit of news, every comment that might be relevant, and every rumor in the hopes of catching a piece of the action. Ranges become larger and risk becomes greater. Over the financial crisis of 08-09, this happened across a broad range of markets. This is what it looked like in the E-mini S&P 500. Well, firms who get into trouble, bargain hunters, opportunist traders, and probably many other categories of participant motivated by the huge shift in prices, serve to increase volatility. The fact that there's more business that needs to be done, that is done more aggressively, and it's done in often much thinner markets, exacerbates moves to both sides. Thinner markets occur as a result of volatility. An order book that once might have been full of bids and offers becomes much thinner. This is for several reasons. Ultra short-term algos tend to get switched off, and they usually make up a large number of orders queuing in the market at any one time. Traders can adjust their usual position size to take account of the extra movement and normalize their risks. Traders are less willing to show their hand by queuing for prices. A clear out of the order book in this way can help the order flow to improve, but does change the magnitude of movement. Average ranges and additionally the number of tradable moves will increase. Taking a closer look at the stats, it's easy to see the difference that it makes. For example, in crude oil, the 20-day ATR in June of last year was at 1.07 per day, compared to its current value of 2.89. That's an increase of over 150%. But what's more valuable to most of us as short-term traders is the fact that this drips down into smaller time frames. The 20-day average range for each 30-minute candlestick is displayed on this chart. I've added lines for the daily peaks and troughs for both today and as a comparison for before the sell-off in crude oil. You can clearly see in this chart that the 30-minute average ranges have increased by a similar factor to what they have on the daily chart. The point of demonstrating to what degree the level of movement has changed is to help you avoid making the mistake of thinking a move that might have been big before the repricing has some sort of wider significance in the market's current heightened state. You shouldn't expect that a move in crude that would have been big 6 or so months ago means anything in particular right now. The participants that I've already mentioned are probably active, and markets can move what seems like a great deal for no particular underlying reason. But the fear of missing out on a great move generated by news or the like can easily have you reading something into movement that shouldn't be. Knowing what the normal movement is for any market that you trade is vitally important in order that you have a frame of reference for what the market is doing and which types of players might be active. But studying market movement isn't just a one-time thing either. Markets are organic. When there's a dramatic repricing of a market, what constitutes normal can at least temporarily change fairly dramatically.